Hello, good morning, everyone. During our last meeting, we considered a case study on financial modeling in project finance and feasibility studies. And this is the case study. Twelve Stones Properties Limited is a social enterprise private company incorporated to reconfigure the dynamics between the private sector, development sector, and rural community through innovation of real estate activities. In order to realize its vision, the company intends to construct 2 residential 60-bedroom hotel apartments in 2 communities of Ghana. The company therefore seeks to raise 1.1 million Ghana cedis, comprising CAPEX financing and working capital financing to fully complete and launch its hotel business in Ghana. We can see that I think there are 2 financing institutions, CAPEX financing and working capital. After technical and financial due diligence, the following revenue items have been extracted. Here they are. These are information on human resources, the number of people employed. You can see there are 20. And this is how much the CEO is taking, 400 cedis, full-time monthly salary. Manager is taking 2,500. The bar manager is taking 1,000. Accountant 2,000. Storekeeper 600 cedis. And up to the cleaner, we have 400. I think the cleaner is taking and watchman are taking the list. And these are the numbers. You just have 1. Manager, you have 1. Bar manager, there are 2. Accountant 1. Storekeeper 2. So if you want to get the total spent on human resources, just to multiply the 4,000 by 1, this by 1, 1,000 by 2, 2,000 by 1, 600 by 2, 500 by 2, 500 by 4, and then sum up everything, right? You get the total spent on human resources. And the next is revenue for rooms. So these are the expected revenues if the rooms are completed. So you have project 1, 2. In the first project, there's a villa. You have number of beds. There are 4 beds in that villa. There's executive suites, the standard suite as well, and standard rooms. And these are the number of beds. And the bed rates per day is 200. The villa is 200. 180. So we expect that if there are 4 beds and each bed is 200 a day, you expect to have 200 by 4. You expect to make 800 cedis a day, right? That's assuming all the beds are occupied. But we're told that the occupancy rate is actually 50%, which means the probability that the beds will be occupied is 50%. What it means is that if there are 4 beds, there's a chance that only 2 beds are occupied in a day. So if you want to work with that assumption, it's going to be 200 by 2 instead of 4, right? Which is 50% of 4. And here, instead of 10, it's going to be 180 by 5. Here you also have 180 by 18 and by 9, right? Because 50%. And yes, what's 60% of 8 is 60, that is 0.6 times 8, should be 48, right? 2.4, right? No, by 8, so it's supposed to be times 2. Yeah, so I got the other one, it's 4.8. Then we'll multiply that by 180. All right, so we expect that this should be 864 per day. So when we do all of this for the first project, we do it this way and we sum them up. It gives us a revenue for rooms in project 1. That's the villa, executive suites, and all of that. We do the same for project 2. 80% of 2 times 200, 70% of this times that. So just multiply 2 by 80 by 2, right? And other income here, bar and restaurant, we're told is constant, 1,300 daily, right? And so if you're to do for a month, is 1,300 for every month for 12 months, right? Other income, monthly. Okay, this 1,300 is daily, so we're going to do daily for 1 month, right? And then we replicate it for all the other months. Remember, we're supposed to do this for 3 years. Another income is 8,000 monthly. We have other information here, which is a year of investment. Okay, this is how much was invested in the initial year 0, and how much was invested in the first year. So this is 916 is actually the initial investment, while 184 is the investment afterwards. So it means that we have a total investment of 1.1 million, right? When we sum up these two. So let's note the difference between the initial investment and the total investment. I think in our previous class, we had a challenge differentiating the initial investment and the total investment. That's where the class ended, right? So let's take note so that when we are calculating the return on investment, we're not going to use 916,000. Neither are we going to use 184,000, but rather we use the summation of 916 and 184, which is 1.1 million, right, for the investment. And I think that is clear. And the cost of sales or variable costs is that the cost for food, how much you spend to get the food ready, the beverages, food and beverages expenditure, and other kitchen purchases, sales and marketing. So how much you spend for probably advertising and blah, 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 I think. So sales and marketing, okay. General administrative costs, admin, utilities, water bill, electricity bill, insurance, repairs and maintenance, fuel, and all of that. All of these are all costs. But what are we supposed to do here? You're expected to calculate the following: profit from operations from year 1 to year 3. So that's what I was trying to explain here. That's what I was trying to explain here, right? But it's a whole work, right? So for those who have this to present as an assignment, you're supposed to prepare a spreadsheet. And that spreadsheet would have a number of pages, right? And to get it. And then you're also supposed to do the total cash flows from year 1 to year 3. You also need the spreadsheet to do that, because this will be a lot of work. If you're to do this manually, then I think you probably need a 40-page, a 40-leaf book to do all of these writings. That will be a lot of calculations and tabulations to do. And then the discounted cash flows and NPV for year 1 to 3, return on investment, internal rate of returns, payback period, assuming a rate of 30%. That is what is this, WACC? Okay, I'm sure you know that. We mentioned it the last time, but in case you've forgotten, try to Google WACC. But the CC means cost of capital and A means average. So, okay. So that's it. And remember I mentioned that you're supposed to get these two from the spreadsheet, right? And I think your lecturer has done that already and extracted this from the spreadsheet. There's no way you can just come straight to get these figures without going through the spreadsheet. So this is an extraction from the spreadsheet. And in a few moments, I'll show you the spreadsheet solution, right? Okay, so this is an extraction from the spreadsheet. There's no depreciation. When do you use depreciation? You actually need this depreciation when you want to find the net profits, right? because the net profit is always the cash flow minus the depreciations. But in this case, there are no depreciations. So it means that for this particular case study, right, the net profit is the same as the cash flow, right? Because we mentioned that net profit is the cash flow minus depreciation. And since depreciation is 0 for all 3 years, it means net profit is equal to cash flow. There's a change in working capital needed. There's no change in working capital, right? So this is 0, 0, 0. The interest has been calculated to be these values, and we will see that shortly from the spreadsheet. The taxes have also been indicated. We can also get that they are here, right? But how do we do the calculations? But in the spreadsheet, they're here. You can also get that information from the spreadsheet, how it was done. And asset purchase, we have for initial investment, year 0 and year 1, but we did not purchase any other assets after year 1. So we have 0, 0, 0. And the loan repayment was constant. It was also stated here. A loan repayment, what was our loan repayment? Was it plus interests? So loan repayment was 754. So let's see if it's here. 754, where can we get 754? Okay, this is also in the spreadsheet as well, because it's not here. It means you're supposed to work on that. Right, so we'll see that in the spreadsheet. And then which other one? Okay, so there's loan addition, right? So that is our loan. Okay, by the end of it means that by the end of the first year, this is a loan so far we've taken. And its raw value. Okay, interest on overdraft. There's no interest on overdraft. So what is the total cash flow? The total cash flow is a summation of the cash flow from profits to interests on overdraft. So look at all of this column. We have only 9160,000. Now for year 1, we have 1.92 plus the ones in bracket are all negative, 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 plus this gives us this value, right? We do the same for year 2, 1.8 minus this, because it's negative, minus this gives you this value, right? And then year 3, this is it. We do the same and we get these values. Now, the total cash flow is what we're going to work with. Take note. It's the total cash flow is what we're going to, there's values here, is what we're going to use to calculate the discounted cash flow and NPV for your 1 to 3 is what we're going to use to calculate the return on investment, is what we're going to use to calculate the internal rate of returns, as well as a payback period. Right, so take note. In that case, I'm going to copy these values out. Okay, that is, take note of the values. I'm writing it down so I don't have to switch from page to page. So this is 1048, 858. The year 2 is 138. 563. Year 3 is 314,882. Okay, I have this, so I can now switch to my Blackboard. Okay, so we have a year. Year 0, year 1, year 2, and year 3. Right. And CF is our cash flow. In this case, our cash flow, we've mentioned, I've explained that a cash flow is the same as our net profits. Why? Because there are no depreciations. Okay, so this is negative. Okay, I prefer to write a negative, otherwise I'll put that in bracket. 916,000 for year one is 1,048,858. And these are 138,563. And this is 314,882 as a cash flow. So this is what we're going to be working with. So, but before we do this, remember I mentioned earlier that I'll show you the spreadsheet solution of the profit from operations for year 1 to 3, and that's 2. That's a total cash flow from year 1 to 3. Here it is. Okay, it's here. Remember, this is the same question. This is it. The CEO, year 1, so we have 4,000 and blah blah blah. Okay, this is actually the question. Right. Units per rate, and then we expect it to do this. Profit from operations. Right. Okay. So that was a question in the data. And this is it. This is a solution. See, we have CEO 4,000, manager 2,005, and blah blah blah. But we're doing this for 3 years, right? So this is for year 1. Year 1 begins from the first month, say January, February, March, April, May, June, right? Up till December. So looking at CEO, for instance, say in December you have 1, right? So these are the total number of 20. And then there's also, you can look at year 2, the same thing. So here we're basically indicating months. And then we move down for the same for revenue. Villa, the 4, 50%, 200. Right. So it means we have 12,000. How did we get this 12,000? I mentioned earlier on that you multiply 4 by 200. When you multiply 4 by 200, you should get 4 by, there are 4 beds times 200. That is 800. But the occupancy rate is 50%. So you multiply by 50%, which is 0.5. And that is 400. So that's how we 400, right? But for 400 times, let's see, 400 should be for a day, isn't it? Okay, let's, which month are we considering? Let's assume month 10 is October. How many days do we have in October? 30 days at September, April, June, and November. All the rest are 31. So let's say we're 31. So that's 12,400. So that's how we got 12,400. Looking at October, month number 10 is October. If you look at month 11, that is November, there are 30 days in November. So you multiply 4 by 200, 4 beds, each is 200, that is 800, about 50% occupancy. So you divide by 2, that is 400. But you have 30 days in the month. So you multiply by 30, that gives you 12,000, right? That is just in 1 month. So you're supposed to do this for all the months of the year, which we've done, right? For all the months of the year. That's it. January, February, March, April, May, June, July, August, September, October, November, December. And when we put these together, it gives us, when we put all of this together, it gives us the total for that particular year, right? And that's just how much we're making from Villa alone. We do the same for executive suites, and that's it. And this is a spreadsheet, so the formula has been entered. And we, for cost of sales, variable costs, how much we're spending on food, right? How much to prepare the food, to get the beverages ready, to food and beverages expenses and others, blah, blah, blah. And so this is it. We're told it's 55%, and then we multiply the 55% by how much? 40,000. Because we're told that for bar and restaurants, right? Well, let's go back and check bar and restaurant. Bar and restaurant. What's that? Beverages, food. Bar and restaurant, 55% of bar and restaurant income, right? So whatever income that we make out of that, and we multiply, we just find 55% of that income, right? And that's how that should be. The income for this particular month was month 8, that's of August, was 40,000, right? 40,300. So we do 55% of this amount. That should give us 22,165, right? And you see, it's a whole lot. It's a whole lot. If we scroll it just for year 1, the yellow at the top is the beginning of year 2, shows for year 2. We also do all of these calculations, right? It's for sales and water view, general, blah, blah, blah. And then we have all of these as our total, summing them up vertically, right? So it's up to year 3. That is how the revenue cost assumptions were made. And then we move on to the profit and loss. So this is how we got these values, right? Remember I explained earlier in our previous class that I was not going to explain details of how this was done from the Excel spreadsheet, right? And otherwise we'll take a whole 24 hours trying to do that. It's a lot of work, right? And so this is it. The turnover, cost of sales, operating expenses, and all of that, blah, blah, blah. We get to find out where in the end, we had the values we're working with. So which is the final? So this is the final. Turnover is this. Cost of sales is that. Gross profit is this one. So when there was no grant income. And this is how we got to the total income. This was how we got to the total income. But if this is a total income, what about expenditure? So expenditure, we've also already calculated expenditure in all human resources, how much is spent on human resources for the first year, for the second year, for the third year. What that means is that going back here, I explained for human resources at a CEO, blah, blah, you do those multiplications and you do all of that, right? How much are you going to, for instance, in the first year, we have 20 CEO, there's one. So it means that CEO is going to receive 12 times because 1 January to December, there are 12 months. And if CEO is receiving 4,000 each month, it means CEO by the end of the first year is receiving 4,000 times 12. 4 times 12 is 48, right? So that should be 48,000. Manager is receiving 2,500 times 12. 25 times 12, that will be 25 times 6. 25 times 6, how much is that? 25 times 5, 125, 150 times 3. Okay, so that's around 450,000, if I'm not mistaken. Okay, don't mind me if it's not correct. So your 1,000 is going to be for how many people? There are two. Every month there are two bar managers, each just receiving 2,000. So it means for both bar managers, they're all receiving 2,000 every month. When we multiply that by 12 for the first year, it's going to be 2 times 12, which is 24,000 for the first year, second year, and third year, right? Fixed salaries. So that is how there's final. That's how we got for the all. When we sum up everything, it means it's how much is spent, 220,000. And for human resources, all the managers, security, and all that. And this is it for the second year, and that's it for the third year. You've noticed that there are changes, right? You expect at least that these values should remain constant, but they are not. Why are the values not constant for human resources? Probably second year, we probably considered some, say, probably 10% inflation or something, right? It's captured in here. There's a 10% somewhere. Okay, there's a 10% you need to consider when doing those calculations. Okay. So that's it. We're the same for sales and marketing, general administrative costs, total operating expenditure, and operating profits. And depreciation, I said no depreciation, but if you had depreciation, we would have subtracted depreciation from the net cash flow to get the net profit. So in this case, this all we have. So in all, we have this as a net profit. We have this as our net profit. Okay. Then here, the investment appraisal. This is the investment appraisal. We used these values. I've mentioned, I've copied that already. The total cash flow is always in for the calculations, which I've done already. Which, okay, we've not done that. I've just written here, and I'm going to explain how I've done that. I've done that on a separate spreadsheet. I'm going to show you that spreadsheet as well, how I did the calculation here. But before then, let's still go back and look at this. So how this is supposed to show us how the discounted cash flow is done using this discount cash flow factor. The discounted, how we got the discounted cash flow, how we get the cumulative discounted cash flow, and then how we calculated the payback period, the internal rate of return, the return on investment, and the net present value, right? So I'll show you here how I did that. This is it. Beginning with the final summary. I just copied the final summary here. And then out of the final summary, how did we do the discounted cash flow? Remember, I told you we're going to pick these values for the first to the third. Make this bold in this. Okay. These are the values we picked from the here. This, and that. So that was our pick. Where is it? Yeah, our total cash flow. This is our total cash flow. So the values we picked here is what I have transferred here to do the calculation for the discounted cash flow. I think, is that the first thing we're supposed to find? Was it the discounted cash flow? Okay, profit from operations from your 1 to 3, we've done that already. I've explained how the Excel, I've shown you that in Excel, how the profit from operations is calculated, and you can imagine the number of spreadsheets we had. And the total cash flow from your 1 to 3 is also in a spreadsheet, which I've just shown you how we did that. Not into details anyway. and the discounted cash flow and NPV. So we're beginning with this one. How you find the discounted cash flow? You need to use the table, right? What table is that? The discount compound interest table. You'll be given that table in the exams, but they usually do that every year. You'll be given the table for exams. You'll be given the table in the exams. And that table will depend on the rate. If it's 10%, you'll be given solely for 10%. If it's 15%, you'll be given the table for 15% for your calculation. Right, so that's how that'll be. But I have mine here. I'll show you how that was done. So how did I get these values? The discounted cash flow, you need to get these values. How do you get that? I'll show you that in a minute. It's here. 30%. It's a screenshot I took from, okay, here's a screenshot. A screenshot I took from this one. Entitled. Yeah, it's a screenshot I took from this. So if you can see there, I copied the present worth factor for single payment, 0.7692. This, take note, this 30%. Right, you don't need all of these headings. You only need the present worth factor for single payment, not for uniform series, and not for arithmetic gradient. In our previous meetings, I've attempted to explain why we're using net present and or the difference between a single payment and a uniform payment series and that. Okay, so we just need for the 3 years, we need this value, this and that. And so that's what I have here, highlighted red. Right, so I can even import it here. Let me bring it here so that file, add image. Okay, 30%, it's here. Then put it at the corner here so that you can see it as we hope it's clear enough. Okay, so that's it for 30%. It's point. For year one, it's always 1. The discount factor at 30%. For year one, for year 0 is always constant 1. So we have 0.7692, 0.5. For year 2, 0.5917, and 0.4552. You get it? Okay, I'm just showing. Then the next one, we are supposed to find. So this actually, what we have to find? I think we're just asked to find the discounted cash flow. So what is our discounted cash flow? It is a discounted cash flow at this stage is the cash flow times the discount factor. So we multiply these two, it gives you that. So these times this is negative 916,000. Multiply by this, you get this. But then there's already using the Excel spreadsheet. And so we'll go back to check, it's here. So that's how we got it. These are the values. So multiply these two to get this. So that's it for, it's, remember it's 30%. So these are the values. These are our answers. Making that right. So we can see well, right. It's a bold. So these are discounted cash flows, which was our first third requirement. But we're also asked to find the net present value. We've done the discounted cash flows and the net present value. So let's go back and check. Anyway, once you've done the discounted cash flow, it's easy to get the net present value, right? What's the net present value? The net present value is simply a summation of all the discounted cash flows from year 0 up to year 3. So if I'm to do that, I'm using Excel here, for instance, some summation. I'm adding this. I'm using Excel as my calculator. Add all of this. Right, close it. So this is our net present value. Let's go back to confirm that. What was presented here? Our net present value here was this net present value 116,127. Right, from your lecture 116,127. So as 116,127. So once you do this kind of cash flow, you can easily get the net present value by summing them up all to get this. It's as simple as ABC. What's the next one? The next is return on investment, ROI. Here it's 10.56%. How do we get the return on investment? Okay, return on investment is simply right. So what's our return on investment? Our return on investment is a ratio, which is our net profit. Is that right? By our investment. Well, it's, I think in this case, the same as our net present value, our NPV, divided by our total investment. And what is our net present value? Oh, I forgot to mention, right? Let me mention, I've got a new tablet. That's why I see I can just write anyhow on the screen. The previous tablets were giving me a problem. At some point, like what I'm writing here, I wouldn't have been able to write what here, right? So I've got a new one. It's 1,400. Okay. It's not pay, it's expensive. The one I bought 5 years ago was more expensive. I don't know why. Interestingly, the one I got, it's 1,000 for last 5 years. I bought 1,500. But even this what I have now is even more advanced because I don't need to connect directly to the computer. It's a Bluetooth, so I can put my computer somewhere, sit somewhere, and connect and write. And so the NPV. So those of you who were asking that I should buy a new one, I'm just informing you I've got a new one, and that's why the class is going. So the NPV here is what was our NPV? Let's go back and check. I think it was 116,000. 116,000. Yeah, 127. 116,127. So 127. All of our total investment. Remember, our total investment we mentioned was the 900,000, and which was spent in the initial year 0, and the extra 100 and something thousand that was spent in the second year. So that was 1.1 million. Okay. But because it's a rate, we just have to multiply it by 100%. Right. So let's check. I've done that already in Excel, but let's use a calculator to confirm. So it's a fraction, like in this one, so it's divided straight. So 116,127, 1,1,0,0,923 is 1.1. 5 zeros. Okay, this is it. Multiply this by 100. That's 10.6%, right? 10.6%. So this is equal to yes, ABC. So let's go back and check what lecturer had. Yeah, 5 sets. So 2 decimal places. Okay, sorry, I had a break in network. So let's go back. We've done the return on investment. Now, internal rate of return is 42%, right? And 42%, that's the answer. But let's find out. Let's do our own calculation and see. First of all, what is internal rate of return? It is a rate for which the net present value is equal to 0. Here, for using 30%, we had a net present value of 116,000. Now the question is, what rate should we use instead of 30% so that our final answer will be approximately 0 instead of 116,000? That rate is called the internal rate of return. So it means we're going to be working net present value. We're going to use net present value to do that calculation. To find that, internal rate of return is not something we get so easily. That rate, we have to do trial and error up to some point. Then when we think we're satisfied, we now use a formula to interpolate and find the approximate value we're looking for, that rate. So we're going to use a formula. But before I use the formula, you're going to do some trial and error. But as much as possible, don't do it too much, right? If 30% gave us 116,000 as a net present value, what should we do so that it drops to 0? Now, anytime you get a positive net present value, to reduce that positive net present value, you increase the rate. But if our initial net present value was negative, it means we have to increase it towards 0. So to do that, you reduce the rate. So from 30%, because this is positive and we need to reduce to 0, we have to increase our rate, the 30% given. So it means that we can try 35, we can try 40, we can try 45, right? But because we already have in mind that our answer is 42%, let's just move on to 40%, right? So I've done that here. I did 40% here. So this was 30%, we had this. When I tried for 40%, I had 18,000. And you know how we got the 40%, the rates? You still go back to your table, the discount factor table, and look for 40%. This is 30%. The next should be 35%, and then 40%. And pick these values 0.71 bubble and 0.5102, and these are multiplied by our discount factor, as we explained, just like we've done. So you have changed this 30% to 40%, and then multiply this by that, and sum them up to get your net present value. As we've done this up, it's here. So that's what I've done, and I got 18,632. You can try this on your own, right? Pick these values and multiply and sum them up. I got 18,000, but this is still positive. Remember, the 16,000 was positive. You're supposed to do the trial and error. If your initial answer was a positive, you're supposed to do the trial and error until you get a negative answer. Then you stop and apply the formula. Please take note. This was positive. So by our second attempt, we still had a positive. But this positive is closer to 0. So it means we're going to ignore the first one we did, which was 30%. We're not going to use this value for internal rate of return because we have a better value closer to 0. Then we tried 45% and had a negative. Voila, is what we're looking for. We stop here, right? But the formula requires that we use both the positive and negative net present values for calculation, but use the last two. So that's why we're not going to use the 116, but rather we're going to use the last two. If we use the 116, you must use one positive and one negative. So let's assume that we decide to use 116, which is positive and negative. We're also going to get the answer, but the answer wouldn't be very correct, right? It would not be very correct. The closer the values, you see this 116,000, and this is negative 23. Before you move from negative 23 to 116,000, you'll probably be tired. That is a very long distance. But between negative 23 and 18,000 is not that much compared to 16. So use these two values because they're closer. The closer the values, right? The closer the values, the better. So we're using these 40% and the 45%. Let me also inform you that I'm going to post this video on my YouTube channel so that any other person in the class can watch, right? Whether you've subscribed to the service or not, I'll post it on my YouTube channel so that they can also watch, right? So I can get some views at least and some, is it subscription and likes? Okay, so this is it, negative 23,000. So let's apply the formula. The formula is back here. Internal rate of return, I've given the definition already. A formula for internal rate of return is equal to the rates for which the last rate, right, which is the lowest rate. No, not the last rate. Take the lowest rate. In this case, we're comparing, we're taking which two? We're taking 18,000 and the negative 23,000. But what rate did we use to get the 18,000? It's 40%. So it's actually 40%, which is the highest rate. And, okay, it's the lowest of the two, correct? I just wanted to be sure. It's the lowest of the two. So it's the lower rate plus a fraction. The net present value we had for using the lower rate, repeat the net present value we had for using the lower rate and subtract the net present value we had for using the higher rate. Once we are done, whatever we get here, we multiply by, whatever we get here, we multiply by the difference between the rates. But this time around, the higher rate subtract the lower rate. That's the formula. Right, so let's go back and take our data. What did we get as our lower rate? Remember, we used 40%. We began with 30%, but that rate was 30%, and we had a net present value of 116. That was very high because we did another one for 40%. We had lower value. So what was our NPV when we used 40%? It was 18,000. Let's use the actual value. It was 18,632.4, 18,632.40. Then we also used a second rate, which was higher, and that second rate was 45%. The NPV for this particular rate, okay, this is for lower rate, and this was for the higher rate. NPV for the higher rate was negative, right? Negative, forgotten. Negative 23,459. 23,459. 23,459 point. Was that 36? I think it's 36. Going back to check. Yes, negative 23,459.36. So let's apply this formula now. Is our internal rate of return. I'll use a different pen. I like using yellow and black. So it's internal rate of return is our first rate, which is 40% plus a fraction. What is this? NPV for the lower rate was this value, which is 18,632.40. I repeat the value, 18,632.40 minus, but this is also negative, so minus, don't forget, 23,459.36. I should have extended this. Then whatever we get here, we're going to multiply by the difference between the rates. The higher rate is 45 and the lower rate is 40%. So this gives us 5, right? This should give us 5. I'm not sure of this, but let's just do straight. I'll use my calculator. So this is 40. I need to shift this calculator. Ah, right down. I can shift it. Okay. I can shift my calculator. Why did I send it so hard? Okay, let me rather shift the screen a little. Okay. I've shifted the screen. So now I can shift the calculator. Bring back my screen. Yeah. Okay. So this is 40 plus, there's a fraction. That fraction I have 1, 8, 6, 3, 2.40 divided by 1, 8, 6, 3, 2.40. Negative is positive, so I just do plus 23,459.36. I need to multiply this by the difference. 45 and 5 has a difference of 5. So that's it. Oh, did I do that mistake? This was supposed to be 0. It's not 4, it's 0. I delete and 0. Equals to 42%. Hooray. So this 42.2%. This is 42.2%. Let's compare. Okay, approximately 42%. So that's 42%, 42.2%. Okay. So what means is that if you attempt to solve a new net present value using this 42.2%, your final answer will be approximately 0. It may not necessarily be 0, but approximately 0, positive or negative, but within that boundary. Okay, because why so? Because of approximations. Remember when solving this, even the rate we're using was approximated. So as long as we approximated the rate, we may not get exactly 0. Our final NPV will also be approximated but closer to 0. So that's it. I've done as promised. I promised to prepare this video for you. I've done that. So see you later today. No, tomorrow. Tomorrow is Tuesday. We'll meet via Zoom for another class. So I'm posting this video on YouTube. You can share the link as well to your colleagues who may benefit from it one way or another. And you will probably be surprised that a number of them are not aware that we are doing this. We're having meetings, right? And it's helping you, I would say, and you've admitted that it's helping. So you can share this video when I send to you. You can share this particular one, not all the others. You can share this particular one with your colleagues. Okay, thank you so much. See you tomorrow, Tuesday, 29th February 2022. And if you have questions, please take note of the questions so that when we meet via Zoom, you can ask the questions before we proceed.